comrades. An accrued expense is an expense incurred, not yet paid. Now, when we get to balance day, which is typically the end of a month, a quarter, half year, or a year, this will necessitate a balance day adjustment in order to satisfy the accrual basis assumption, which requires us to recognise expenses when they're incurred. The period assumption is also in play here. Now, apart from the recognition of the expense that's been incurred, accrued expenses also create a current liability because there's an obligation to transfer an economic resource, which will generally be cash, and this obligation is expected to be settled within 12 months, so it satisfies the criteria for the definition of a current liability. So let's have a look at an example here, which is split into 3 stages. So the first stage is simply dealing with the cash expense that have been incurred, in this case during a month. So what we have here is on the 28th of June, we're just going to record the 58K in wages that have been paid during the month. We'll do that in the GJ and the GL, and then we'll move on with the BDA and the subsequent period. So let's go down to our GJ. On the 28th of June, this is where we process transactions in our journal. And so there's no GST in this one, so we only need 2 accounts. So it's a debit to our wages expense going up for 58K. And we do a credit entry to our cash and bank for 58K. I'm not going to bother with narrations. Let's post this now to our GL, General Ledger, with a debit entry to our expense account, cross-referencing it with the bank for 58K. And we'll do a credit entry in our asset, bank going down, wages, 58K. Alrighty. Then we get to stage 2. We get to the 30th of June and we read this memo stuff. We're owed another 2K for working the last couple of days in the month. Payday hasn't hit. And so therefore, given the reports are prepared 30th of June, this is balance day. So again, therefore, to satisfy the accrual basis assumption, we need to recognise this 2,000. So therefore, let's go to our GJ, 30th of June, and we're going to record this as wages. Wages have increased by 2,000. The expense has been incurred. Staff have done the work. And we create a liability account called accrued wages, a liability, as we talked about before. Let's post this to the GL to see what this looks like. So our liability account is being credited, it's increasing. We cross-reference this with wages. We don't touch the bank, no money's changing hands, 2,000. And then we top up our expense account on the 30th of June. Accrued wages, 2K. Now, before we get to the 5th of July entry up here, because our reports are prepared on the 30th of June, this is balance day. So therefore, we need to close off our expense account, wages. So therefore, I'm going to close this off in preparation for our following period, which will start on the 1st of July, so that we don't mix up our wages from 2 separate periods. And this is where the period assumption comes into play, because what we need to do to satisfy the period assumption is to divide the life of the business into finite periods so we can compare performance over time. So therefore, I'm going to close this off to the P&L summary. And again, by doing a credit entry on the credit side of the wages, it's now zeroed off. Okay, so we did this in the GL. Let's just have a look what that would look like. So again, that would just be a debit entry to your temporary P&L summary, and you would do a credit entry to your expense for the total expense incurred for the month. And then we get to the 5th of July, the next reporting period, and the staff have been paid $7,000, and this includes the $2,000 owing from the previous month. So again, we need to split this. So this is how we do it. Let's start with our BDA entry, which is where we process it. We have our accrued wages. Now, this is the liability that is being reduced because we're settling our, liability to our staff. So therefore, there's an economic resource here that's being used to basically settle that debt. So therefore, that's a debit entry to our liability account. Now, the wages for the July period, that's the other $5,000. And so therefore, that's $7,000 is coming out of our cash at bank, which is split between the $2,000 from the previous period that was accrued, that was owed, and the $5,000 from the new reporting period starting July. So let's just post this and see what this looks like in the GL. Careful with your dates here. So cash at bank, 2,000. So what this highlights, given we've got matching totals on both sides, is that this account has been formally balanced. It's zeroed. We've underlined it on both sides, so therefore that debt is settled. Now in our wages account, we zeroed it off to prepare for the July period, so now we can top that up with a entry for the 5,000 that related to the July month. Again, we don't want to double count 2,000 because 2,000 was already recorded at the end of the previous month in that accrual. So therefore, just be careful with that one. And then in our bank account, you could either do a split entry, which I'll do because my cross-reference cell is not wide enough, accrued wages, 2K, or you could do a combined entry, doesn't really matter as long as we get the amounts right.